now live.
Excellent. Excellent. We've been yakking away.
I know. Sharing all the exciting things, what we want to do as entertainment events next year.
Yeah, yeah.
So, Richard, welcome.
Nikki, hello.
Good afternoon. So you haven't got your new normal backgrounds of your boxes, Richard. So where
No,
are you today?
I'm close to Newmarket.
What?
Newmarket races. A friend's birthday, and I've graciously allowed you this time, Nikki.
I feel so special. Thanks, Richard. So
You're welcome.
welcome everybody to the Business BoardCast. I'm losing track of how many you are now. I think this is about our 5th or 6th. Because this is becoming a great weekly feature of people's diaries. So please do pop into the comments and say hi. So I know that it is. Well, it's always useful if I see one come up so that I know we are definitely live and there's not a technological problem. So today we're going to be talking about share incentives. So whether this is for typically for business owners, whether when they want to start introducing share incentives, but also if you're manager of business, it's useful for you to know as well, because it's another tool in your box and you can badger your owners that this could be a good thing to do. Please do. We've got a lot to cover. We're only in half an hour, so it's a lot to cover, because I know that normally if Richard and I were talking to clients about this, we'd be probably gabbing on for about an hour and a half.
Days.
Days, yeah, that would just be the intro meeting, because there's lots of content to go through on this. So so please do ask questions as we go along, and we will cover, but there is a few main points we want to make sure that we do cover today. So hopefully you're all sitting comfortably, got your sandwiches or your tea or coffee, and we will crack on with share incentives. So Richard, so you're experienced tax professional and business advisor. So why should a business owner look at share incentives?
There are so many reasons. And the way in which you can design a share incentive scheme can give you benefits in different areas. But broadly, if you're looking to motivate your team, retain or recruit, perhaps you're a startup and cash flow is a bit light, so think about share schemes then. If you're an owner looking to exit the business, another time to look at them. If you are perhaps an owner who wants to part exit and look at semi-retirement, there's an option there for you as well. So a myriad of reasons to look at a share scheme, and I think we're going to talk a little bit about the different types.
Yes, that would be great. Yes, because there's lots of people might be familiar with EMI, but there's actually lots of different ways. So yes, we'll definitely go through that. But so where I think you just touched upon it there about when is the best time, in the company's life cycle. Is there just one certain time, or is there lots of different times that they could be looking at?
Any time in the company life cycle, at any point. I think the important thing is that you know where the company's going. Is it growing? Is it flat? Is it a mature business that is just that has flattened, or a mature business that's growing, or a new business that's just starting up? Or are you a business owner that is getting towards the end of your working life and you're looking towards retirement, semi-retirement, whatever that may be? So at any point, the key is to understand where you're at and what it is you're trying to achieve.
Yeah.
So
Mike's just done a really good comment about, cause with the time frame. So if you are pre-sale, he had a great example. So lovely Mike Ames. When I sold my first business, the staff shed £3 million.
Yeah.
What a nice owner there. And I was delighted to write the checks. We believe it kept the team together for the life of the company and the earnout period. So that's a great example where share
Absolutely.
incentives really did work. And
Yeah.
so
Yeah.
because it's a great thing for a business that you are looking for an exit as well, isn't it?
Absolutely. Absolutely. It's not just for staff motivation. There are benefits in there for the owners as well.
Yeah,
You know.
because absolutely, because you want, when you're selling the business, you don't want to sell the business where all the people have gone or you haven't got them left. So they need to be tied in somehow.
Absolutely. Absolutely.
Absolutely. So share different. I believe so. There's different types of share. Oh, well, no. First of all, can you define what is a share incentive? Just for the those people
Well,
out there that have not come across this before.
a share
Share
scheme,
incentive 101.
it could be anything from giving shares to employees, selling them to them at a discount, selling them to them at full price. It could be providing them with share options. So that's the option to buy in at a later point, but perhaps at a very low price with an expectation of maybe a sale of the business in the future. It could be that they're given a promise of shares in the future. Now, we don't see that very often in the UK, other than in the big American firms, but you may have heard of restricted stock units. So Amazon and so on will give their teams restricted stock units, which they then get to sell perhaps 2-3 years down the line. We won't talk too much about that sort of thing at the moment, but just be aware that, I mean, they're out there.
But that is relevant for some of our tech clients that do hope to get sold to Microsoft or Twitter, etc. That's often is part of what they get. So but yes, it's for those clients we'll go into detail offline. But yes, it's not necessarily for all of our clients. Absolutely.
Now, each of those different types of schemes has their own tax regime, if you like. They're all treated in slightly different ways for tax. I think probably what we'll focus on today are what we call the tax advantaged schemes.
Yeah, but it's key thing, isn't it? People aren't choosing these schemes just for the tax advantage.
No.
It's part of, that is just an extra bonus, the fact that it gives you some tax incentive.
Yeah. It must fit with the business strategy.
So which ones in particular, what sort of ones do you come across most for the typical sort of SME?
The most popular for SME owner-managed private businesses would be the Enterprise Management Incentives Scheme, which is the EMI scheme. A number of reasons, great tax benefits, but they're relatively simple to set up. And because of that, they're relatively cheap to set up. On the downside, they are what we call share option schemes. So they give your employees the option to buy shares at some point in the future. If there isn't a sale of the business contemplated in the mid-term, your employees are unlikely to see any value in being given share options.
But you mentioned, so very detailed, a bit more detail into the EMI. So you say about it's very easy to set up, but I'm actually surprised how many times I've seen EMI share schemes not set up properly. And Mike's full of things today. He's saying I don't know whether this was a EMI one or not at that time, but his scheme wasn't set up properly and caused huge problems for the employees. He's obviously typing very fast today. But so that is really important, isn't it? Because otherwise they think they've got these fabulous tax incentives, but then they come a cropper when it actually comes to the point of sale.
Absolutely. We think they're quite simple to set up. Unfortunately, a lot of people think they're very simple to set up and just miss the technical detail. You've got to, because there are so many tax benefits with these types of schemes, you do have to tick some boxes to get those benefits. It's not particularly difficult, but you've got to absolutely get it right.
Yeah.
There are the issues I come across commonly with EMI are not reporting.
Mm-hmm.
So when an employee is awarded share options under an EMI scheme, they must be reported to the revenue within 92 days. That is a common one that's missed, and there is no leeway with the revenue. If you miss that by a day, that's it.
Yeah, that's it. You're lot stuff.
Yeah. The second one I come across is the annual reporting. So each year you have to do a return to the revenue. It's very simple, but it's easy to miss. You have to do a return, just letting the revenue know whether there have been any changes, whether any options have been exercised, whether any more have been awarded, and so on and so on. And a lot of people just think, well, we don't need to do that.
Yeah. They go, oh, well, nothing's happened this year, but you still got to file it.
Absolutely. If it's just a nil return, you've still got to file it. And if you don't, you'll lose all of the share scheme benefits. While we're talking about benefits, shall I talk about the EMI benefits?
Yeah. What are the benefits?
What are the benefits? So you give an employee the option to buy some shares. The value or the price that they'll pay for those is agreed with HMRC upfront. So we'll go to HMRC and we'll say, how much is 5% of shares in this company worth? It's a minority shareholding. We can apply a massive discount to that. So the employee can pay a very, very small amount for a number of shares. When those shares are then sold, the employee pays capital gains tax on any increase in value. An added bonus is that they get to pay a reduced rate of capital gains tax at 10% rather than 20%, perhaps, if they're higher rate taxpayers. The company doesn't have to pay any PAYE, any NI on that share exercise. So it's very advantageous for the company and for the employee. Company also gets a corporation tax deduction when the employee exercises, and that corporation tax deduction is on the gain on the shares.
Yeah, and that's something I often see missed. Obviously not our accountants because they know how to do it, but that is something that people, and then so then you don't realise there's a share scheme because it's not being recorded in the accounts with that at that point.
Now, typically, an option scheme like the EMI is set up so that the employee can exercise the option, buy the shares at the point that the business is sold. And that's the only time that they can actually do it. So to incentivize them, there has to be some midterm goal to sell the business. If it's not clear that it's there, then it's not going to be an incentive.
No.
This is just not going to work for them. And then we have to look at a different type of share scheme.
Okay, Nigel, you are forgiven.
Hello, Nigel.
Nigel. The lovely Nigel. Yes. Okay, so EMI, great, and that's a massive saving. If you're getting you're paying 10% instead of having to unauthorized share option schemes. People sometimes think they've done some sort of share option scheme and it's unauthorized, and then they've got to pay 40 or 45% tax, personal tax, plus the national insurance. That's a huge difference
roughly
compared to a relatively small, modest charge of setting it up properly. Absolutely.
Yeah,
Okay, so lots of good reasons. EMI is straightforward, brilliant tax savings, even some tax savings for the company as well on the exercise, which is brilliant.
yeah.
Excellent. So what other type of methods do you see?
Well, the quite a common one I see is what we call growth shares.
Ooh,
So where you have a fairly mature business, and you might bring in a key team member who you know or anticipate will have an impact on the business and on the future growth of the business. What you can do is give them a special class of share, which broadly just participates in the growth of the business in between them joining and then selling the shares, which
yes.
might be when you exit the business.
Which is brilliant if you've got like a real key new manager bringing in that's going to
Yeah,
make a big difference to a division or
yeah,
your business overall. That's really good. So you're keeping what you've built up, but
yeah,
what they're going to help to build, they will then benefit from.
yeah. And from a tax point of view, these growth shares have virtually zero value when they're given to the employee, because at that point there hasn't been any growth.
No.
So they might be at par value, they might be £1 each. So you'll
Mhm.
ask your employee to pay you £100 perhaps for 100 shares. No tax implications there at all. You haven't given them anything. HMRC don't want to see any tax paid on that. But then when the time comes and they've hit the hurdles and profits have been made and the value has risen, they'll then pay capital gains tax on that difference.
Okay.
If they've held the shares for 2 years, again, they'll only pay 10%.
Okay. And sorry, so do they just pay that when they then sell the shares
Yeah,
on that gain? Okay, not
yeah,
just because it has gone up.
yeah.
Just to be
No,
clear to
not just because
everybody
it's
out
gone up.
there, just to be clear.
Yeah.
With the growth shares, are they available to any sector? So they could be relevant to any type of growing business, key
Absolutely.
growing business.
Yeah.
Excellent.
As
Because
long,
that is one thing to remember with the EMI, isn't it? Because I love the EMI scheme, but as someone running an accountancy practice, I'm not allowed to have an EMI scheme because there are certain ones that they're not allowed,
yeah,
they're not
yeah.
applicable for, aren't
I
they?
mean, there are lots of restrictions around EMI schemes because of the massive tax benefits. There are restrictions on the size of the business, so a maximum of up to 250 full-time equivalent employees, for example. Net assets can't be any more than 30 million of the business. You can't award more than £250,000 worth of options to an individual, so on and so on and so on. There
Yeah.
are
So
all
it's good. It's good, really good for early stage or smaller businesses, isn't it? Yeah.
yeah, yeah. Fast
Not
growth
yeah.
businesses, perhaps to attract.
Perfect for our fast track clients, the ones
Yeah,
that get onto the fast track times list, which we've got quite a few. They're perfect for those types of businesses.
yeah.
They've done. In fact, actually, I think almost all of the ones that we've had have got some sort of EMI scheme.
Mm.
Absolutely. Okay. And there's lots of people to mention about like John Lewis schemes and things like that. Is what are they all about, Richard?
I mean, I'll give you another example. Richer Sounds, for example. I
Oh
mean, everybody
yes,
knows Richer Sounds.
yeah.
They've set up this type of scheme. It's indirect ownership of the company by the employees. So where I see it used most is where a
Sorry,
business.
there was just a noise. That isn't your battery about to go, is it, Richard? Just to make
No,
sure I'm not going to suddenly use. Okay, that's fine.
no.
Okay, just a
Um,
random sound. Sorry, apologies. Can tell this
where I
is
see,
live.
where 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 I see this type of arrangement used most in private businesses, owner managed SME privately owned businesses, is where the owner is looking to pass on the baton They've got a great management team in place. It's a profitable business, and they just like to either step out of the business and retire, or just step back a little bit, perhaps carry on as chairman, that sort of role, but are
Chairperson,
prepared,
yes.
to pass on the baton to the team.
Yeah,
Very
so brilliant for
simply,
succession planning.
very simply, what happens is they will sell at least 50%, in fact 51% of their shares, to something called an employee ownership trust. Now, normally when you sell your shares, you've got to pay tax on a capital gain, haven't you?
Yeah.
If you transfer to an employee ownership trust or sell to an employee ownership trust, there is no capital gains tax.
Perfect.
A
No tax at all.
tax-free,
What? Tax-free?
tax-free sale of your business.
Goodness.
Little bit of a downside.
Oh.
The trust doesn't have any money, so it can't pay you for your shares.
Wow. 0% tax of nothing. Fair enough.
But all is not lost.
Okay.
It's a profitable business. The business can make cash contributions to the trust over the years. The trust can then use those funds to pay the owner for those shares.
So essentially you're selling it in a loan type arrangement, and then you'll get the money back later.
Yeah, absolutely. But your costs are relatively low because you're not having to deal with brokers.
Mm-hmm.
You've got a very amenable purchaser, put it that way, that you can agree a valuation with, a reasonable valuation with. You don't have to go down an earn-out route, for example.
Yeah.
And we know that a lot of earn-outs don't pay out.
Yes, indeed. Yeah, so it takes away a bit of the risk potentially, but then it also then potentially can take away the upside if you actually manage to get a really good deal selling it on the open market.
Yeah, but if you could get a good
So
deal on
there's
the
ups
open
and downs.
market, you'd get a good deal selling to the trust.
Yeah, okay.
Because the trust is a willing buyer, and it essentially, at the end of the day, it's an open market price.
Yes.
The only restriction is that you do need to agree the value with HMRC.
Mm-hmm.
So if it's massively inflated, then HMRC might not look on it very kindly.
Yeah, and you need to make sure your management team are going to be able to run it to make the money, so you can eventually get that money.
Yes, but saying that, these types of arrangements allow you to carry on as the chairman director.
So that is a potential win, depending on your viewpoint.
Depending on your viewpoint.
Yeah.
So you can carry on as director if you want to.
Mm-hmm.
You can be the trust protector. So you decide who the trustees are. Typically, you would have on the board of trustees, you'd have a key employee, because at the end of the day, it's an employee ownership trust. The trust owns the shares, but the shares are held for the benefit of all of your employees.
For all of them. I find that. And there's another nice little incentive, isn't there, about for the employees can have a little £3,000 a year tax-free as well, don't they? Which is the other nice thing. That's a nice little win for the employees.
It's free of PAYE. There's a little bit of NIC to pay on it, but it is free of PAYE, and it is tax-free. I mean, as time goes by and the loan is paid off, so the original loan is paid off, the trust has more and more cash and can make larger distributions.
And also because you could potentially be still owning some of that business. So you might have just sold the 51. So if you then have an external sale, and later on you're still getting some of that benefit of that upside too.
Absolutely.
There's lots of win-wins. That is a really, it always sounds a very attractive one, but it's just making sure that all the key bits are in place for that one. But it's got a lot of potential, hasn't it?
A massive amount of potential, and we're seeing a lot more interest in these now. I don't know why, but for some reason, COVID has crystallized a lot of owners' business thoughts, and they are heading towards the employee ownership trust. A lot more interest in those.
Well, a lot more of they've actually seen their mortality, and then they want to actually sort out their succession planning, isn't it?
I think so.
Yeah, and get that new work-life balance as well sometimes.
Yeah.
Excellent. So we've only got 5 minutes left. So if in case there is any questions that anyone's got on any of the types of share incentives, whether it's a tax question or how you administer them or where you start for setting them up, what the starting point is, this is time getting quick before the curtains are fully drawn at 1:00. We can, as always, people can watch this on catch up if you've missed part of this. So Nigel, so you can watch it on catch up on our YouTube channel. Don't forget our Gorringe Accountants YouTube channels. Click and subscribe. Do you need a few more subscribers? Because my son is going crazy on his YouTube subscribers. I've got no chance of catching up on his. But anyway, get a few more, and then you can catch up and see all the back catalogue of the Business BoardCast as well. So, any questions coming in? But in the meantime, just in case anything comes in, what just refresh people, what are the top things that they need to be getting? Sometimes people go sort of, they don't really know what they're doing, and they sort of then start talking about shares, and then it ends up talking for years on it. What are the key things that any business owners that are thinking about doing potentially a share scheme, what things do they need to consider? What's your top tips for that?
Top tip is nail your business plan. Understand what your strategy is, and that will then highlight, do you need team? Do you need to retain team? Is that your business model? Do you need to incentivize them? What's your cash flow like? Can you replace cash flow with shares? Very broadly, what you're looking at is if you're awarding share options, you've got to be very clear with your employees that there is an exit route. Otherwise, there isn't an incentive for them. If you're giving them shares, they have to see that there's going to be some value in those shares, whether that's a dividend payout in time, or there's going to be growth in those shares. And again, there's an exit strategy. It's about transparency, if you like, ethical management, and a very clear business strategy. So talking through your business plans with Nikki, perhaps working out your strategy, and then out of that will come, what do we need to do to achieve this goal? And a share scheme would be a very valuable tool in the armory, but it's not a magic bullet. You can easily throw money at it and it be totally meaningless. It has to be designed to fit the business. They are very, very flexible. If you think a share scheme can't do something, you might be wrong. And there may be a way of structuring it to actually achieve what you want to do. But knowing what it is you want to do is the key.
Absolutely. So plan. Absolutely. Thank you so much, Richard. That is lots of useful stuff in there. And just remind people how they can get hold of you, Richard. Is it best from LinkedIn? How would you like people to contact you?
Well, just email me. What's my email address, Nikki? Richard.
Well, you have got a Gorringe one, yeah. Richard.feakins@gorringe.email. Gorringe, Goringe. Yes, and we're both on LinkedIn. So do or just comment on this if you're watching this on LinkedIn, and both of us will see your comments and be able to reply. But thank you so much, Richard. Thank you for interrupting your friend's birthday celebrations. thanks. I'm very grateful. Thank you.
And thanks to all our viewers for coming along for the ride.
Excellent. Thank you so much. And have fun at the races. Hope you win big.
It never happens. Thanks, Nikki.
Okay. Bye-bye.
Bye bye.
Cheerio.
Bye bye.